Welcome to the TFSA Tour, where we are going to be going over some of the different options that you as a consumer in South Africa have for your tax-free savings account. During these few videos, you'll get to see the different offerings that you have from banks, financial institutions, and how I think you should actually go about utilizing your tax-free savings account. I'm not going to go over what a tax-free savings account is or, the different limitations and all of that. I think many people have made videos on this, but I'm basically just going to be going over a tour of different options from different companies of what you can possibly do for your tax-free savings account. Let's go. So to kick us off, we're going to be starting with FNB's offerings when it comes to their tax-free savings, and we're going to actually navigate over to their website. Now immediately you're greeted with call it about three options. You've got a tax-free cash deposit, tax-free shares, and tax-free unit trust. We're going to go into all of them quickly. It must be noted that they are slightly different, and depending on who you are, you'll kind of need to decide what works best for you. But in the end, I will tell you what I think my preference is. Tax-free deposit, this is, they say you get a lot of rewards and so on and so forth. You can go over what's in it and the rates, what they're speaking about for yourself. But basically, it's going to be, sort of a cash component. So this is money that's not invested into any companies, shares, or anything like that. It's purely just like a normal, fixed deposit account that you'll get. The good part with this is that you're guaranteed, an effective annual interest rate, which is good for preserving your money. But at the same time, you're not really getting any benefits of it. And yearly, your maximum contribution is 36,000 rand, and yearly it's 500,000. So think about 500,000 just sitting and earning a measly call it 4.7% interest rate, which really isn't good. So that is the first thing, the cash-free deposit. That's the first interest rate you're getting 4.75, which is good for preserving your money, but really it is not a good option. But I guess for preservation it's good. Next thing, they've got a tax-free shares account, which says invest in the top 100 companies in the JSE using FNB online banking or the app. So basically what it means is that you're going to be in some sort of top 100 index or thing like that, and that is where your money will be saved. So they don't actually go into great detail of showing you exactly where, what, or how it's being saved. All you get to see is kind of the fees, what they are, that there's a brokerage fee and that there is a fee according to the value of your portfolio. But they don't really give you, a fixed interest rate to say this is what you're going to get. It just shows you kind of the benefits of a tax-free savings account. So this one could be better than the other one, could not be, because it actually says here an investment in the top 100 companies gives you the best chance of growth through the Ashburton Top 40 and Ashburton Mid Cap ETF. So maybe at the end we'll go over these two individual things or individual ETFs for us to see actually how it pans out or how it could do. But I think it's definitely better than the first option of a fixed interest rate, in that if the market does well, you'll do well, and over time I do think these things just tend to grow regardless. So I think over time you'll do much better here than you would with the other guy, the deposit. But when things are bad as they are now, your account will be looking pretty sad, whereas those who are getting the fixed interest rate are looking pretty okay because they're used to the same thing month on month. So next, you've then got the unit trust, and this is where I sort of want us to put most of our attention, because this is where you sort of should be living or looking to invest. I think similarly, so how this one works is that you give your contribution amount to FNB, but you sort of tell them where you want them to put the money, right? And as you'll see, there's got the income fund of funds, which is inflation plus 1%. You've got the stable fund of funds, which is inflation plus 2%, moderate funds, inflation plus 3.5%, growth funds, which is inflation plus 5%. Then you've got the growth plus, which gives you, well, they actually don't actually have a proper thing, but I think it's probably going to be similar to the CPI plus 5%. And we're not really going to look at the Islamic based fund because I don't properly understand Islamic banking. is probably something I should look into, but to fully understand how it works, because as far as I know, they're not supposed to charge or earn interest. So anyway, that's a topic for a different day. But basically here, these are unit trusts that you are in. And if you know, when we've gone over our unit trust video, that when it comes to, you know, investments or grouped investments or whatever you want to call them, you know, unit trusts tend to be a bit more expensive than you know, ETFs. So even thinking about that, you can find that the actual other one of shares, which, you know, had, I think it was almost about 0.6 plus the 0.1% brokerage fees, so almost 0.7% yearly fees. These can end up being a bit more expensive. And if you click on the fund fact sheet for the income fund of funds, you'll basically get this screen here where you'll get to see, okay, cool, it's the income fund of funds. I'm not going to go over the entire document, you'll be able to see it, but they show you the benchmark is 1% or CPI plus 1% over a 1 to 2 year rolling period. They show you the fund size. It's being managed by Ashburton. And yeah, this is basically all of the information. You actually come over here to actually see the fee structure, and here you'll see the management fee is 0.62. I think the total investment charges that they have here is 0.63. So actually it's not too bad. But here's one thing that I think they, you know, kind of pull wool over our eyes with. And I think, let me continue to go over this and you'll understand what I'm going on about. Next up, yeah, you'll see kind of how they've allocated it. It's quite heavy on cash. There's fixed income, international, local equity, local property. So they've really not taken any big risks here, but they are not, you know, being expected to do much. It's basically just going to be sort of like a money market thing. And here you kind of get to see the performance. You know, year to date, it's gone up by 1%, not great. 2021, almost 8%, which is decent. 2020 is 5%. So, you know, they generally, you're looking at somewhere between 5, 6, 7%. I think 8 is kind of the upper limit of what you can expect here, which for what they've said that they're going to do, I think is quite good. This, you know, single percent so far that they've done in a pretty bad 2022, I think is quite decent. They also do have distributions, but this is actually where you'll get to see why I think the amount of money that they say that they're actually going to take from you isn't a true reflection of what your cost will actually be. Because the first thing that you see is that they've got cash. Cash is cool. There's, you know, no fees that you'll pay. Well, there's fees that you'll pay for converting and all of that, but they sort of build it into the total thing, so it's not that significant. But the Ashburton Global 1200 Equity, FQF, is, I believe it is its own unit trust, which actually has its own fees added onto it. And they don't charge the fees or add the fees onto the amount that this charges you. It's already, you know, included in the unit trust price. So you're essentially paying fees for this overall unit trust, and you're paying for the Ashburton. But as you'll see, they've actually bought out of it for this period, similar with the Satrix, which will also have its own fees. So that's 3 things that have their own fees. Ashburton Money Market, they've kind of come down a bit. This is Ashburton Stable, so they've kind of kept it there, but it also has its own fees. Cash, then there's Local Fixed Income Ashburton Bond Fund, which is a pretty good way to kind of keep you know, returns stable and consistent, but again, fees on that. The Ashburton Inflation ETF, which they've bought out of. The Government Tracker, which again has its own fees, and I'm assuming this is FNB's version of that, or it's FNB's inflation ETF, which again has its own fees, and the multi-manager Propsy, which also probably has its own fees. So what kind of kills you here is that there's fees on top of fees, and it's not really clear to you, you know, that those fees are there and they exist. I have spoken about this a bit in my retirement savings video, so you can go watch that. But everything here, you know, is heavily focused on trying to keep as much of your money as possible and, you know, not play with it too much. I think probably the reason for selling out of the you know, Ashburton Global Equity, I thought they would maybe replace it with something else, but I think it's because they've seen that the market is sort of taking a downturn and they're kind of holding on to it. And that's or trying to hold on to as much capital as they can. And that's kind of the beauty with unit trust, is that there's someone who is actively managing this fund, who knows and sees market trends and what's going on, and sort of makes the best move depending on what their mandate is. And because here capital preservation is a big thing, they've kind of bought out of a lot of their position, and probably these two international equities, I think they've actually thrown into this local cash portion here. We did waste a bit of time on the other one, so let's quickly go over the stable funder funds. Stable funder funds, we're looking at 2%. The last one was 1%. Here we're kind of looking at 2%. Here cash is a lot less. Fixed income is done a lot more. Local equities a bit more. International is a lot more. Property, I think, is more or less the same. They kind of show you how they've distributed or given it to different people, and this is actually showing you how they're doing versus their benchmark. I didn't go over it over the previous one, but this is a minimum disclosure document. You guys should know what these kind of look like. You'll see the total investment charge here is a little bit more. The previous one I think was 0.67. This one is almost a single percent. So you'll see the more riskier or the more returns that they give you, the more that you should expect to be paying, because there's a lot more management going into it. Here you'll see year to date they're not doing so well. They're actually down, but last year 15%, decent. Almost 7% the other year in 2020. So this one ranges quite a bit, and they do also have their income and their distribution there. Here you'll get to see kind of where it is. They do have a little bit of money in cash. They do have a dollar market fund, which again has its own fees, and they have just normal US currency. They've sold out of the Ashburton Global Equity Fund, the iShares Core EMI ET. If I'm assuming that is, I've actually never looked at that, so it might be worth looking into. Then I think they've got their own ETF. So this Ashburton one is probably being replaced by what FNB is now creating. That's probably why they've sold out of this one. It was almost 11%, and they've hoid that 11% back there. Satrix, MSCI, and another MSCI from Satrix again have their own funds. Ashburton World, which it seems they've completely sold out of, but they've come back and added their own. So I think they're actually replacing a lot of the Ashburton ones with their own FNB ones. I don't know if that's going to end up being overall good or bad for you. Then they've got currency contracts, local equity, which is Ashburton, but again, selling out of it, I think, to make their own, because there's an FNB Top 40 ETF. And that's kind of how they've allocated all of the money. So better than the last one in that they're taking a bit more risk on global and local equity, but it's still not there, but you're paying more than you were for the previous one. If we come on over to the moderate fund of funds, moderate fund and funds, I'm really not going to go over everything. The total investment charge, it's now 1.19, so almost 1.2% is what they are charging now. And if you come on over to where they have your money, again, a whole list of, there's more international equity here that they've got, a bit more from Satrix. I think the one thing they've added from the previous one is the China feeder. That's the one thing that they've added here, and they've probably have different allocations versus the other one. And in local equity, I think they've pretty much kept it, or this multi-manager, I don't think they had it in the previous one. And fixed income pretty much looks like it stayed exactly the same. Property, I think, as well, percentages also still very much the same. So a bit more riskier. I think they've just hoid a bit more money, particularly in local equity here. That's kind of where the difference of this one versus the previous one is. I kind of want to see the performance. Last year they did 19%. The previous one was on 15%, 5%, 11%. So this one does a little bit better. It's down a bit more, but they do take a lot more risks. But the important thing to note, the investment charges have gone up. Cool. Then you've got the growth fund of funds. If we come down over here, you'll see the total investment charge went up to 1.4%. So it is, incrementally going up. You'll see local equities 50%, and international is 24%. fixed income, fixed income, local property, total cash. So taking a bit more risks with your money, particularly putting it in local equity. But last year they did really well, almost 23%, 5%, 11%. So I think when they do well, I think they do really well. This 22% is decent. And if you look over here, you'll see local equity, they've added, international equity. I feel as though they've added something else. It's just the China, actually no, it's the same as the previous one, that they've just added the China, but if you come over to fixed income, I think it's pretty similar to the previous one. Same with the money market. But where you'll kind of see the difference here is that this FNB multi-manager has a much bigger chunk versus what we had previously. And this is where the bulk of the difference between the fund of funds and the moderate fund is that they've hoyed a whole lot more here. The ETF is slightly higher, but I think it's more or less the same as what it was, and everything else is pretty much more or less going to be the same. But based off of this would be kind of, if I wanted to go with FNB or an FNB product, where I would put my money, because it has the best return. Last year it did 23%. Not saying that that's what it's going to do in the future, but that kind of gives you an indication of what you should be looking for and expecting. This year, I don't expect any double-digit increase here. I would say this year I expect somewhere in these fives. They were even negative one year. I think it's the first one we're seeing where they're actually negative. So don't expect a lot here, but I think they also say themselves that this one is kind of like a 7-year thing that you need to have over a longer period of time. And we can look at the growth plus fund of funds, which they do not have. It says it's close to new business, but just to kind of see what the key differences are between this one and some of the other ones. This one, I think, international equity, they kind of bump up to about 30%, and there is no, I think the last section that they normally have is cash, so there's no local cash component here. Everything is invested everywhere, and I think with that, when you come on over to what they actually have, I think their local equity is pretty much the same. International equity is actually quite a bit more. Actually, they've put a big chunk in international equity here, so I guess that's the one nicer thing about this one, is that international equity is quite up, but you also take the risk from that. I just want to see performance, how they've been doing. Last year I did 27%, great. I think the performance on this one is slightly better than what you'll get. There's almost a 5% difference year on year, but again, you can't really get access to this. But if you could, I would say this would be the best offering. See that you can expect more than the sort of 22 to 27% maximum across, maybe not across 7 years, because you won't get that over just the 7 years, but yearly return, you can expect to see a lot better elsewhere. That's the FNB's offering of all of the tax-free shares/savings account. See you guys in the next video.